Well, Katie, I think that the main thing investors are watching for is the idea that the Fed is very unlikely to do anything with rates. And the WIRP function in the Bloomberg terminal, or the World Interest Rate Probability function, it's a 0%. I can't remember the last time I saw for a meeting it's 0%. It's usually at least 1% or 2% or a great percent that they will either hike or cut. But for this meeting, it's 0%. So a rate change is very unlikely. So this would be the second consecutive pause in a row. But most do expect the Fed to maintain a tightening basis. The question is, does this mean a pause at current levels, or is there some sort of final hike or hikes in view? And then the current view, inflation, of course, some of the numbers recently, in particular September's core inflation, crept up just a little bit, but there was a summer of disinflation. When we put it together here in the Bloomberg terminal, the Fed's target rate is in white, and this goes back to 2013. In blue, we're looking at the PCE year over year. That, of course, is the Fed's preferred look at inflation. And then yellow is CPI. So you can see for many years, all below 2%, meeting the Fed's mandate. And then we have both CPI and PCE shooting higher, well above the Fed target rate. They acted quickly, as we all know, raising rates. And now it's interesting to see these measures of inflation are below. But the question is, are they below enough? And how worried is the Fed about sticky inflation in terms of what happened in the 1970s? They want to make sure that inflation is down. Now, I would say in July, many investors were surprised by the fact that the Fed signaled that they are staying in tightening mode or tightening bias. And with this, we have the S&P 500 down 8.6%. But take a look at this. This is absolutely stunning to me. In 3 months, Scarlett, we have that 10-year yield up nearly 1%, shooting higher toward the 2-year yield. In fact, the entire yield curve is there, accepting the idea that we're in this higher rates regime.